Welcome to this new episode of Your Next Trade. Today, episode number 11 after Turkey. So we had the whole week, very quiet week with Thanksgiving from Thursday onwards, meaning as we discussed last weekend, that this week will have been and was very quiet. So if as usual we start with our week-to-date asset performances, what we can see is that the equity market, the stocks, did pretty well for the week, up between 1 to 2%. So we are carrying on with the equity rally that started in October. So we have been moving another 1 to 2%. So the picture is more or less the same as the other end of the spectrum, as the assets are still moving the same way. The US dollar has been weakening. Since we have seen the bottoming in the US dollar, that we have seen bonds as well bottoming, everything has been moving the same way. So the correlation are still very strong between asset classes. Bitcoin, crypto have been consolidating after the digestion and still digesting the information of the collapse of FTX. WTI, interestingly, is the most volatile assets these days. So there is still uncertainties between the China slowing, the world slowing and going into potentially into recession, and the OPEC that could actually now reduce production. So last week we had some rumors that OPEC could increase the production, but it's probably not going to be the case. They're going to be meeting in a week time and making the assumption and clearly saying that as the world is slowing, the demand coming down, and to adjust the supply versus the demand, there is a good chance that we could see lower demand supply going forward. Natural gas, both in the US and in Europe, are going higher. Why? Because winter is really upon us in Europe. If we look at the week-to-date industries performances now, what is interesting is you can see that the moves of those charts have been flattening. So we used to be having a market with high volatility. We are talking daily volatility, weekly volatility. But what has been happening is now the realized volatility, like the implied volatility that we can see with the VIX, has been coming down drastically, which in other words, the change that we have on that party of the chart has been coming down quite a lot. For the S&P, we are at less than 2%, but overall you can see that a big chunk of the moves are between 0 to 2 to 3%. So in other words, it's time to adjust again the sizing of our portfolio, the sizing of our positions. Why? Because when this volatility is coming down, we can increase a bit the position. That means taking a bit more risks. But as we're going to see later, there might be a change in the near future. About the rates, I like to be looking at two things. I like to be looking at the US 10 years and looking at the yield curve. So looking at the US 10 years, which is here, we are 6.8%. We have been coming quite a lot from the highs around 4.3 to 4.4%. So we have been down around 60 to 70 bips, 0.6% to 0.7%, and actually week to date across the world, as long as you don't have the central bank intervention like Japan and China, the bonds have been pretty strong on the week. Why? Because we are still now expecting less intervention from the central banks in terms of probably reducing the size of the balance sheet in the near future, but for the time being, not maybe at the end of the hiking cycle for rates. If we look at the 10 versus the 2, minus 77 bips, so it is even worse than last week. It is getting worse, as you know, and as I'm saying over and over every single week. This is a very good leading indicator for the cycle, for the recession coming in the US. So looking at the 10 versus the 2, you can bet with 70-80% plus that around March, June next year, the US will be in recession. Euro dollar, what is interesting, is very similar to any other asset classes that we underline so far, is there has been almost no change from one week to another. So if you compare the last, which was as of yesterday for the euro dollar curve, from a week ago on the 18th, it's very much the same. Literally, as I said last Saturday, the Thanksgiving week is a very quiet week. Not much is happening. What we have from this week is a follow-up of the bear rally, but no more than that. The VIX, same picture. The VIX is coming down. So implied volatility keeps on coming down. Now we are in the low 20s at 20.5%. So interesting level again if you are looking at strategies to build either hedging or directional. Why? Because when volatility is at 20%, implied volatility is at 20% versus 30%, your premium is much lower. That doesn't mean that the volatility will come back again, but it is very often a much better way to switch from hedging from let's say futures ETFs and to go back into calls and puts. What we have as well is we know that the market is very much distorted, but zero debt to expiry options, meaning options that are expiring on the day. So since September onwards, roughly 50% of all the options traded in the US are expiring on the day. So as market participants have been quite shaken by the volatility this year, they are more and more looking at short-term options, and instead of playing single names or looking at the futures, they will allocate some budget on the day and say, okay, this is the way I'm going to do it for the day. And as well, what we can see is many of those options these days have been call options. So many market participants are betting on the equity market, as we are talking about equities here, at the S&P and the Nasdaq going higher every single day. So far, that has been the case. The trend is your friend. We're going to see when we'll be looking at catalyst if something could be derailed. So let's look at the chart now. We're not going to be spending crazy time on it. Chart is starting with the S&P, with the futures. The trend is still the same, going higher, and as long as we don't reach, so we're going to have the 200 moving average soon, and we're going to have, more importantly, the trend that is coming from the highs that we had in December last year. So this is the trend. We get another 100 points, 2.5% before reaching those important levels. If you look at the Nasdaq is not as strong as the S&P, but we have been consolidating over the last 10 days. So consolidating, volatility coming lower. The Russell, same picture. So if we do the same chart versus on a weekly base, you can see that the candles are getting smaller and smaller. Let's go back into the daily. If you look at the DAX, actually the DAX has been performing very well. And if you look at the DAX, if you look at the Euro Stocks 50 and the Stock 600. So yesterday I looked at the performance. Interestingly, if you look at the the Stock 600 year to date in dollar terms, so if you take into account the weakness of the euro, it's exactly the same performance as the S&P. So do a chart of actually I should have done it today. If you look at the S&P, you put a chart of the S&P, you put a chart of the Stock 600 divided by the euro dollar, and you will see that year to date they are following each other, and now they are almost at the same level. So that is quite interesting, because if you remember 3 months ago, that was, oh, Europe is going to be going, sorry for my English, into a shit show. It's going to be horrible. The winter is going to be terrible. This is the end of the world. And even if when I talk to people, they are always coming from Asia, from the US, they talk to me and say, look, Greg, I'm sorry for you. I hope everything is okay. But actually, Europe is doing fine in terms of maybe only charts. But what it tells you is actually winter so far has not been, I mean, it's very early, has not been so far that bad. And actually, if you look at the PMIs that we're going to discuss later, Europe has been doing pretty well. I mean, it's pretty much relative, but that tells you a bit about the picture and how the momentum has been and the flows. Be always careful with the flows, because you're gonna have 2-3 weeks, 2 months, 3 months of flows, then suddenly it could rotate. And if the perception towards Europe gets worse again, due to the low volume, the low liquidity in the market, you could have like a deep fall. Emerging market, as long as China, which is making 50 to 60% of this index, is not getting better, and we know that despite saying that they will be targeting COVID, that the big cities in China are going into lockdown again. So there is a bit of worry. You've seen the pictures probably of Foxconn plants, the Apple factories in China that are been closing. So there is a bit of concern. If you look at the stocks, I think the trend is now, so the trend has been broken on the upside. Now, I will say that you're going to see some consolidation. So this is my bias. Euro dollar, similar. We are
Translation, Potter 360, fiscal irresponsibility leads to inflation and unemployment, says Barroso.
Okay, and the dollar yen the same. So consolidating, and for all of those assets, we are looking for the next move. CL1, which stands for WTI, about to be making new lows. So this one is the one to watch, because I think if we really make new lows below the 75 going into this week, and at the end of and especially at the end of this week, that tells you that the market participants are really expecting a big slowing of the economies. And if that's the case, then you get a mismatch between the S&P rallies, the stocks 600 rallies, because it's going to be hard for earnings to be growing as much as they should to justify those levels for the different indexes. Let's go back into the Excel spreadsheet looking at this week. So as I said last week, we were about to have like a very quiet week. So that's Thanksgiving. So the first chart that I put is the SPY daily volumes in August. So here this is for the summer. You see the kind of volume that we have, and actually for this week we had lower volumes or very similar. So very often with Thanksgiving, nothing is not much is happening. Why? Because most market participants will go away and being with their families. I'm talking about the US, and as the US is the market leader in Europe, we are just following, and same in Asia. So volume coming down, meaning as well lower intraday swings. Okay, so something that we discussed. If you look at the ATR, the daily ATR, the daily moves, the swings coming quite a lot down. True for the index, true for the sectors, true for the industry, and true for the single name. So lower intraday swings, lower volumes. Interestingly, we had a bit of economic data on Wednesday. So on Wednesday, we get the flash PMIs, both in the US and in Europe. So in the US, the services came out at 46.1 and 47.6. And actually, this is 3 months low for both. So the trend is still down. And in Europe, those are still below 50%. So a recession is here at 48.6 and 47.3 for the manufacturing. But actually, the numbers were a bit better versus the expectation, and not as bad as feared. So maybe it's only a window, which is due to not having a cold winter so far in Europe.
Translation, UOL Brazil, Bolsonaro does not speak at first public event after election defeat.
Bloomberg again. So my catalyst for the week. So Thanksgiving is over. And if you have been trading the market, that you know that between Thanksgiving and the biggest expiry of the year, which is on the third Friday of the month of December, we might have some activity. So until between now and let's say Christmas, you might have some activity, some action in the market. Then after Christmas, normally for the next 2 weeks until the new year, not much is happening. So looking at potentially 3 weeks of action, when is it going to be starting? For this week, we get a Fed Powell talking on Wednesday, just before three important economic data. We get the PCE, So inflation, you knew and you know now the CPI has been peaking in the US and the numbers have been looking better. So we're going to be checking if there is a follow-up. If inflation comes better, you can be sure that the market will carry on moving up for the stocks. If you look at the ISM manufacturing, this is the flash PMIs, but the confirmation of the flash PMIs, how it's been doing and how the sectors, what are the sectors that have been trading. So very important for ID generation. And then as well, we get the NFP on Friday. Why those two PCE and NFP numbers are important? Because if you come back, you take a step back and look at what is the Fed looking at, they get a dual mandate. The dual mandate is based on inflation and full employment. So NFP, that will be for the employment on Friday, and for the PCE, that will be for inflation. So far, the labor market in the US has been doing very, very well. Many Fed speakers so we're going to have Bullard on Monday, we're going to have Powell, Cook, Boone, so all the Fed speakers here are kind of expecting and want this unemployment rate to go up, because that will imply probably that inflation will come down. There is a scare, and so far that has been true, that the first inflation is now coming, the second derivative of inflation, where you get inflation for wages, meaning as well it could put pressure on margins for companies. So we know that margins from companies have been coming lower, and that is a big worry, because that implies as well that earnings will come down. It could come down more than expected. And if earnings come down more than expected, if you look at the correlation between earnings growth and the S&P growth, then you get problem. In terms of earnings, you're still gonna have, 95% plus of the companies have been coming with their numbers, have been releasing their numbers, but you're still gonna have interesting names like Salesforce, like Dollar General, like for the football players and football fans, you get Manu on Friday, which is making the headlines these days on the potential sell. So you might have some update on this. So some names, some sectors, some industries that will be impacted. Two things that I put here. The first chart is we're going to have the FOMC meeting on the 14th of December. So again, between mid next week to the 20th of December, we're going to have higher volume than versus this week. We're going to have more activity. Most hedge fund managers, prop traders will be looking at some special situation, will be looking at specific events that we're going to have. So this is the time to still be making money. People that have been missing the rallies might be jumping and be like the FOMO, the typical FOMO, and will have to jump and follow. So what we have is we got the FOMC meeting on the 14th here, where the expectations are mostly at 50 bips, 0.5% hike, but that still could be 0.75. It seems to, so far we are at 0.5%. And finally, for this FOMO and for this seasonality, what is interesting is we had the best historically since 2000 and let's say since the beginning of the markets. October, November, and December have been the best 3 months. So this is the best quarter of the year. So so far, October and November have been pretty good. Now we are looking at December. December is not necessarily as good as October and November, but this is a positive month. So we are talking for the S&P, for the Nasdaq, for the Stock 600. So you have a lot of positives leading into markets going higher, but it's mostly depending on the macroeconomic now, and how the Fed will react, and how the Fed will say, okay, what I'm going to do in the next 3 to 6 months. We know that the inflation is close to peaking. We know that we are getting close to the end of the cycle, of the cycle of hiking rates, which is 3 or 6 months from here. Now the question is, if you look at 2023, it's all about earnings. If you're looking at stocks, how the earnings are going to be playing. So we are talking top line, and we are talking as well margins. For the top line, the world is slowing. If the GDP is slowing, it's hard to have like a crazy top line. And if you look at the margins, if you get inflation, if you get pressure, if you're still going to have supply chain issues, that means your earnings, your overall earnings, could be coming down. So that's something that probably I'm going to be covering when I'm going to be doing my 2023 IG generation, and that would be for later. So this is it for us today. Video series, if you are interested, so of getting a full investment process if you want to be trading your own money or having access to the industry. There is a 25% discount until the 31st of December 2022 using the Holiday 25 coupon. If you get questions, you send me an email. If you want to join the trading community, please do so. We are on Discord. We are growing. I like the energy that is coming. So we should and we will carry on. Thank you for today, and don't forget that in less than an hour, the French team will be playing in the World Cup. All the best. Bye-bye.